What's your prediction for Bitcoin? Will it go up in the next month, or will it be around current levels? I don't think that there's too much upside potential. It's always hard to say, right? I don't try to give predictions. I always think about what's the potential upside versus the potential downside. And currently, historically, right, we always fell quite a bit from the all-time high. I believe that if history is any indication, we could fall up to 72% from the all-time high, which would bring us to the 40K levels. But of course, history doesn't necessarily have to repeat itself. That's where we potentially are headed. But I don't try to give predictions. I'm very much okay to just change my mind if momentum suddenly changes. So what I like about the moving averages, right? They first of all outperform the market very well. Just buying and holding obviously is not as good as following the trend. What I also like is that it's kind of a hedge because it follows trends. It doesn't necessarily decide on where we are headed, right? If we are below, we simply bet on falling prices. We can make quite good gains, right? So if we look at the moving average vault, the copy trading vault for the premium members, it made quite some gains, and measured in Bitcoin, it's up. So the idea is that we just want to quote unquote stack more Bitcoin over time and outperform the market. Really, when you look at investments in general, you want to check, are you outperforming the benchmark? Not are you making US dollar gains? If you trade, say, technology stocks, is your portfolio doing better than the Nasdaq 100? If you're trading crypto, is your portfolio doing better than Bitcoin? If you're trading precious metals, is your precious metals portfolio doing better than, say, the gold market? If you don't have those kinds of benchmarks, if you just look at the general US dollar performance, you are distorting the picture. You're not really looking at the competition. And the competition is always just passive investment in the market. If you do nothing and you just passively invest in gold, or you just passively invest in Bitcoin, and you get X return, and you look at this as a reference point, it's much better than just looking at the US dollar price. Because let's say the US dollar devalues by 50% because for whatever external event, right? Let's say a lot of new money gets printed, all assets go up by 100%, and your trading portfolio goes up by 90%, and you spend hours and hours every single day to just trade. You feel like you're the king, you made 90%, but really versus the benchmark, you even lost, and all of that time that you actively traded was for nothing. The idea really is that we want to increase our skill to a degree that the additional performance versus buying and holding is high enough that it justifies spending all of that time. So there's two components to trading. There's on the one hand the execution part, where we have to follow the changes in the market, where we have to see what's going on. But really the majority of trading time should not be the execution, where people just draw lines on charts and try to figure out what's going on right now. That should not be the majority. The majority should really be developing skills. It should be developing how to do backtests. It should be figuring out what really was driving the price. We should really figure out what kind of approaches could potentially work. What kind of platforms can we use to optimize trading fees? What kind of psychological issues do we potentially face? How can we monitor our risk properly, that in the worst case we don't lose everything if we suddenly see mispricing or flash crash, etc. It's really the skill development that gives us the long-term edge, because in the end it's both a game of luck and a game of skill. It's a mix of both of those. There is a luck component, but there's also a skill component. And the higher the skill component is, the more we outperform long term. And so in order to outperform, we shouldn't execute all the time with 0.1% alpha per year. We should rather work a lot to increase our alpha per annum, and then maybe execute a bit less. So it's operations versus business development. It's executing trades versus improving skills. And really, the majority of time should just be allocated towards improving skills, improving our approaches. And that's, I think, what most people get wrong.
With the 44-day simple moving average strategy, would it make sense to be more aggressive with short positions since we are still in the bearish trend, maybe 2x?
No, I do not think so. I think it makes most sense to only change leverage if our macro picture has massively changed. Let's say we are below the realized price, and then we go above the moving average. It might make sense to increase the leverage that way, but only also up to the level that historically worked well, right? Currently, when we go long, we go 2.25x long, but actually the best leverage is 2.75 5x. So 0.5x more. But we don't take the 0.75x because of the potential downside that we have, right? The volatility, we want to reduce that. But if you're currently below the realized price, if our macro picture tells us we are super, super cheap and that the next rally could be massive, then it might make sense to adjust this to 2.75x. But outside of that, yes, we are currently in a bearish trend, but we are getting closer and closer to the realized price, and historically it was best just to use the 1x, and so I continue to do that. Also, what's very important to note here is when we look at the gains that we make from the different positionings, right? When we look at leverage versus expected annual return, we make actually very little additional return with the short position, which kind of makes sense because this is Bitcoin. Bitcoin tends to go up over time, and so we are trying to make money betting on falling prices of something that tends to go up over time. So it's almost a miracle that we can make money with shorting in an asset that does multiple X returns all the time. But we do make some returns. Not massive returns, but some returns. But if we were to increase this to 2x, then our returns on average would go to 0. So then we have the odds against us. So currently we make all of this return by betting on falling prices, but that's actually not typical at all. The vast majority of gains are made on the long side. It's by making harder bets on the long side and being levered long when most people can't do this, right? If you were to go 2.7x long all the time in Bitcoin, you just have to wait until you get liquidated, right? Because Bitcoin can drop 60, 70, even 80% from the all-time high. So you cannot afford to just hold Bitcoin by close to 3x all the time. Really, what in the end this moving average strategy is doing is we get slight benefit from bear markets, we make slight profit in bear markets, but really what it enables us is that we can get levered long in a bull market without getting liquidated. That's really where the majority of gains are coming from. If we get back into a bull market and we are in it with close to 3x, then we make the real gains. Then we outperform everybody else. And most people can't do the 3x returns without getting liquidated. And by managing our risk with the moving average strategy, we can. And that's what differentiates the strategy from just random gambling. There's so much more value to come. You've only watched a small, tiny clip video. The entire episode is available over here. Just press here to watch the video.